Welcome students, we're going to be looking at support material 2. We're going to be covering more of those support units in your study guide. The first chapters we're going to be focusing on, chapter 4 and then 5. We're looking at the background regarding the investment management subject that you have. Just a note, remember when looking specifically at INV2601, we're looking at context. Context is key. So each of these topics are broken up into different sections. So when looking at topic 1, we're focusing on background information in the investment world. The first thing we need to do is just recap a few things from the previous week. So remember, we're looking at the differences between nominal and real returns. Just remember, when using the actual formula to work out the relationship between nominal, real, and inflation, it's always advisable to use the actual real formula using the 1 plus nominal equals 1 plus real times 1 plus inflation. That's going to give you a more accurate representation of the real interest rate, taking nominal and inflation into consideration. So please just remember, you do have a summarized Fisher equation where nominal equals real plus inflation, but for a more accurate representation of the relationship between real, nominal, and inflation, please use the 1 plus nominal equals the 1 plus real multiplied by the 1 plus inflation. We also spoke about holding period returns and yields. Just remember, when looking specifically at investment management, you're going to be investing capital in various assets, and those assets are going to hopefully generate a return on investment, a positive return on investment. So when you're looking at your holding period yield or your holding period return, these measures identify the actual amount of return that you're generating for that particular period of time. So when we're looking at holding period return, just remember, it's always looking at your end value, including all the cash flows that you would have received, divided by the start value or the investment value. And if we're looking at the yield, we're going to be looking at that as an interest rate, so as a percentage, like an interest rate. Right, so return for the holding period will always be over a period of time, and when looking specifically at the value that's being generated over that investment period, we're going to view that as a percentage. That will obviously be the yield. Then just another note, something very important from your previous set of notes in support material 1, we spoke about the importance of understanding what capital asset pricing model is, K or CAPM. CAPM describes the linear relationship between risk and return. So when you're looking at various decisions, you're going to be establishing what the required rate of return is, and that's obviously calculated taking the risk-free rate into consideration, plus any market risk premium for taking on risk in the market. So remember, when we're looking at investing, we're going to be trying to maximize the return on investment, but we're trying to minimize the risk as much as possible. So when we're looking at CAPM, please use that equation. Required return equals the risk-free plus the beta times the market return less the risk-free, which is basically your market risk premium. And if you add your risk-free, you're going to get the required rate of return. Then we also looked at decision making, where we had the actual CAPM pricing model. Just remember, when you have CAPM and you're looking at the required rate of return, that's always going to be compared to what you've expected. And that could be calculated using the holding period return. So if you're looking at an overvalued asset would be an asset that has a expected return which is less than what is required. So if you think about it logically, if the required return is more than what is estimated or expected, that means that this investment that you are considering is not giving you the right level of return because your estimated or expected return is less than the capital asset pricing model, so CAPM. So we wouldn't want to invest because we would consider that asset being overvalued. But alternatively, you would consider an asset being undervalued if your estimated or expected return is greater than the required return. Greater than required return, meaning if you've done the calculation and you've looked at the investment, and that investment is offering a much higher return based on your expectation, based on your calculation, compared to what you require based on the level of risk in the market, you would definitely consider investing in that asset because you would generate better returns than what you could get having invested in the market. So always remember that an undervalued asset would be an asset that could generate much better returns on investment going forward. So you would definitely want to invest in undervalued assets. You would want to buy when assets are undervalued, and you would want to sell when assets are overvalued. Okay, so new content. We've recapped some previous important concepts that we need when doing workings and calculations in investment management. When we're looking at study unit 4, you'll see the focus here is on time value of money. So if we're looking at time value of money, you need to remember how to calculate present value, future value. You need to look at the N, the time period, the I, the interest rates or the yield, and then also looking at compounding. Okay, and we need to consider if there are any additional payments because that could form part of an annuity. So when looking at this particular study unit, we're going to be focusing on time value of money calculations. The first thing we need to do is establish the difference between a nominal rate and an effective rate. So if you go look at the market, any bank or any institution that's offering some sort of return on investment, they would definitely quote rates in a nominal percentage form. In other words, that's the quoted rate that the investment is going to provide. So a quoted rate could be something like 8% compounded annually. If we're looking at converting that nominal rate to an effective rate, well then compounding is definitely going to have an impact on what sort of return on investment we're going to be getting, because the effective rate is basically taking compounding into consideration. So if the nominal rate is 8% compounded annually, well then if it's annually every year, then if I look at the effective rate for 1 year, they're going to be the same. But if I have a nominal rate that's quoted, let's say 8% compounded monthly, because something is compounded monthly, that means you're going to be earning interest on a month-to-month basis. So in actual fact, the effective rate on that particular investment is going to be slightly higher than what it would be if compounding was normally per annum. So just remember, the more frequently you compound or add interest on interest to a particular amount, it's going to definitely change and increase the actual return over a period of time. Because remember, nominal is just what's quoted, effective is taking all that compounding into consideration. So let's see how that works. Just remember, when looking at nominal, it's quoted. You're not going to be using quoted returns in calculations. When you're doing time value of money calculations, you're definitely going to be using the effective rates. So the effective is what you actually need when doing calculations with time value of money. You need to take that compounding into consideration when doing calculations. Right, so here's a very basic example just to explain the differences between what a nominal rate is and what an effective rate is. So on the screen you have an amount, 1,000 Rand, which is invested at 6% compounded annually. So the question is asking you, what would the return be after 1 year? Well, if I'm investing 1,000 Rand at 6% compounded annually, because this is annual compounding, that means every year you're going to be adding interest on interest. You're not going to be compounding more frequently. So if you're looking at your calculation using time value of money, and this is where your financial calculator will come into consideration. You're definitely going to be using the financial calculator to do these workings and calculations. You would insert present value into your calculator. You would insert in the number of periods as 1, and you would insert a I of 6 divided by 1. Okay, remember the compounding is every year, annually. So I'm not going to change the 6%. If I divide by 1, so per annum, I'm still going to have 6%. So your I would be 6%. And then if you compute for the future value, you get 1060. What happens though? Let's consider what happens when you have a nominal rate that is now compounded more frequently. So for example, if I had to take that or this scenario and elaborate on it in a bit more detail, if I'm looking at a 6% rate that's compounded annually, because it's an annual compounding, the effective rate would be exactly the same because the compounding isn't being done more frequently. In other words, you have a full year. Every year you'll be adding interest on interest, but for the year, the interest is only being added to the original amount once a year. So every year there'll be interest on that particular investment. So in other words, the effective rate would be identical. So just a note, nominal and effective, you're just taking compounding into consideration. Right, so now we need to look at what would happen if compounding was more frequent. When I say more frequent, for example, if we had to compound the actual interest monthly. So if it wasn't 6% compounded annually, let's assume it was 6% compounded monthly. Would that change the calculation? Well, the answer would be definitely. So if we're doing the same working, same calculation, but except instead of having 6% compounded annually, we have 6% compounded monthly. So what is the return after 1 year? Well, in order to do the calculation, again, use the financial calculator. You're going to be inserting present value as 1,000. Your N is now going to be the number of periods for each compounding. So in this example, we've got 6% compounded monthly. So if you think about a year, there would be 12 months in a year. So you'd be compounding that particular investment 12 times a year. So in actual fact, the number of compound periods increases from 1 period, being 1 year, into 12 months. So you need to insert the 12 months here in order to get the correct future value. When looking at I, again, because I've got 6% compounded monthly, it's important to use a monthly interest rate. So to calculate a monthly interest rate, you're going to be taking the 6% and you're going to be dividing that by 12, which is the 0.5% compounded per month. And then we're going to be computing the future value. And if you solve for the future value, you'll see the answer that you get is 1061,677,812. Right, so is there a difference here? Well, definitely. Previously, when we were compounding every year, the compounded rate, in other words, the effective rate, was the same as the nominal rate. Here, our nominal rate was quoted at 6% compounded monthly. So if we're looking at an effective rate is looking at the return on investment over a period of time. So in order to do the calculation, you'll see if I'm working out the actual growth, in other words, I started with 1,000 and I ended with 1,061,677,812, that actually gives me an effective rate for the overall period. So in other words, the full year, as a rate of 6.17% if I'm rounding that off to 2 decimal points. So that's something to note. And then something else that's very, very, very useful, especially when doing calculations, is you need to be able to convert the different rates, taking compounding into consideration. So I've given you an equivalent rates formula here just for you to use when making conversions or when converting one rate to another. So just remember, if I'm doing any calculation, it doesn't matter how simple or how difficult, you always have to check that all the variables are going to relate. Your N has to relate to your I. Those are the most important in terms of timing, because you have the number of periods and then you have I, which would be the interest rate that's going to be used, okay, according to the compounding. Right, and then payments would be your annuity, so how many payments are you making? Present value and future value is just the amounts, what you started with and what you end with. So when you look at the equivalent rates formula, it's quite simple. When looking at all of these different variables, you need to make sure that all the variables are in line. So if I'm using months, everything needs to be in months. If I use quarters, everything needs to be in quarters. If I use days, then everything needs to be days. So it doesn't matter. It just depends on the question. You need to be able to convert one rate to another depending on what's asked for. Right, so what do we do if the effective rate does not correspond with the payments? Well, the answer is you're going to have to do a calculation, a separate calculation, to make sure that all of those variables are in line or are matching in terms of their focus. So if it's months, you need a monthly rate. You need payments that are monthly. Right, so the three most important variables to remember that need to relate is N, I, and PMT. Right, those are the three important time value of money variables that need to relate to each other. Okay, so how do we do these equivalent rate calculation conversions? Well, the general equation is 1 plus IM to the M, and that equals 1 plus IN to the N. So it all depends on what you've been given and what you're trying to calculate. So in this example, we have 8% compounded quarterly. So that's the nominal rate. We can denote that particular rate as being I4. I4 meaning the quarterly rate. Let me just add that on screen. And we've got that as 2%. Okay, so 2% is what the quarterly interest rate is going to be. What would the equivalent annual rate be? So in other words, you're trying to solve for I1. That's the question mark. Right, so you'd obviously put I1 here, and then you put I4 there, and then you would do the calculation to solve for I1. I1 is the annual interest rate. So you would have 1 plus I1 to the 1 equals 1 plus I4 to the 4. And then it's just a matter of applying basic math arithmetic. You're going to be solving for I1. So if you take everything to the one side and leave I1 as the subject of your equation, you're ultimately going to get 8.24%. So let's interpret this calculation that we've done. We said in this example that 8% is going to be compounded quarterly. If that 8% is compounded quarterly, well, then you're going to have a quarterly interest rate that will add, or quarterly interest that will be added to the basic amount, the principal amount, the present value, and that will increase over a period of time. So over a period of a year, you're going to have 4 compounded periods. Each period is going to have a certain amount of interest that's going to be added to the amount. So if we're taking compounding into consideration, then your actual effective interest rate is 8.24%. Here's another example. This is 10% compounded quarterly. So what would the equivalent monthly rate be? So again, important to note, quarterly is I4, and that's been given. And then your equivalent monthly rate would be I12. So because I12 is unknown, that will go on that side, and then the I4 would go onto this side, and then you would solve the equation. You'd be searching for I12. Right, so just to show the solution, what I would suggest you do, if you are watching this video, please just pause the video here, write down the equation, 1 plus im to the m equals 1 plus in to the n, and then substitute your I12 and substitute your I4, and then see if you can calculate using arithmetic what the actual I12 is going to be before you watch the rest of this video. So pause the video here, do the question, and then come back and look at the solution. Alright, so the solution for the equivalent monthly interest rate is going to be as follows. 1 plus im to the m. I need to show these solutions here. Okay, 1 plus im, which is I12 to the 12, equals 1 plus I4 to the 4. And if you solve for your equivalent monthly interest rate, the answer that you get is 0.8264837%. That's your equivalent monthly rate. Equivalent monthly rate meaning I12. So I12 can be calculated from I4. I4 is the interest rate per quarter. So you're trying to convert a quarterly rate to a monthly rate. And that's important to note. So quarters and months are different, okay, obviously. So if you're looking at converting quarters to a quarterly interest rate to a monthly interest rate, you're going to use this equation to calculate it. Right, here's another example for you to try. Again, please pause the video, do the calculation, and then come back and check your answer. Here we have a 12% monthly rate, which would represent I12. So I12 is what's given, which will be on this side. Okay, and the question is asking you to solve for an equivalent semi-annual interest rate. An equivalent semi-annual interest rate would be I2. So I2 is the unknown, so you would write that down on the left-hand side. So 1 plus I2 to the 2 equals 1 plus I12 to the 12. And then you're going to do the arithmetic and solve for your equivalent annual interest rate, and you're going to be getting 6.152015%. That's the answer for the semi-annual interest rate. And then there's one more example for you to practice and try. What happens if I have a 6% compounded quarterly interest rate? Well, if it's compounded quarterly, this would be your I4. I4 is what's given, so that would be your IN in this scenario. And then you're looking for the equivalent annual rate. So equivalent annual rate, that's nice and simple. I'm looking for I1. So in your formula here, you would have 1 plus I1 to the 1 equals 1 plus I4 to the 4. And then you'll do the arithmetic and solve, and you should get that answer there, 6.14%. That's your equivalent annual interest rate if you have 6% and it's compounded quarterly. Okay, moving on to other time value of money calculations. These calculations require the use of your financial calculator. So remember, please make sure you know how to use your financial calculator. If you don't, please let me know and I will assist you. We're looking specifically at time value of money. We're looking at principal, well, PV, and we're looking at future value, or FE. And then we have different ratios, or different variables, I should say, in the actual question. So you're looking for things like N, you're looking for things like I, and you're looking for any potential payments. So this is a question for you to practice, to try, to see how well you can cope with these time value of money calculations. They should be very easy. All you have to do is literally grab your financial calculator, insert certain values into the financial calculator, and then solve for the missing or unknown figure. So in the first question, you invest monthly deposits of 500 Rand at the start of each month in an interest-bearing account offering 7.5% compounded monthly, and you're required to determine or calculate what the accumulated amount is at the end of 7 years. Right, it's very important to identify the variables that you need in this question. Obviously, it's begin mode because it's the start of each month. Okay, so at the start of each month, you're going to be depositing money. If I start, I need to change the calculator into begin mode. Right, so begin mode, your payment, because this is annuity, it's a monthly deposit. So PMT will be 500. Right, the number of months, okay, each month. So we had 7 years, so 7 times 12 is going to give you 84 months. And then what rate did you have in the question? Well, 7.5% compounded monthly. So the interest rate here would be 7.5% divided by 12 to get a monthly interest rate, because I have the number of periods in months. Right, so your N, your PMT, and your I, they all need to relate. Everything is months here. You've got a monthly payment, you've got the number of months, and you've got a monthly interest rate. And if you compute and solve for your future value, you should get... let me just reveal the answers. You should get 55,359.7853. Let's have a look at the next calculation. Okay, in this example, You would like to know what you should pay for an annuity that pays a monthly amount of 10,000 Rand at the beginning of each month for 10 years. A return of 6% compounded monthly is expected for the investment period. Right, so here we're looking at practical time value of money calculations. So the goal here is you want an annuity that's going to pay a monthly amount of 10,000 at the beginning of each month for 10 years. And obviously you know what the interest rate is going to be. Right, so you want to know how much you should pay for this annuity. So we're looking for the present value. If we're looking at the workings, again, begin mode, because this is beginning of each month. So make sure you have your calculator in begin mode. The payment is obviously 10,000. Your N, remember, is 10 years, but because it's each month, you need to multiply that by 12 to get the number of compounded periods. So N is 12 times 10, or 10 times 12, either or, which gives you 120 periods. And then you've got a interest rate of 6% compounded monthly. So 6% divided by 12. Once you've done that, you're going to compute your present value, and your present value comes out to 905,238.2059. So that's representing the amount of money that you would have to pay in order to receive this monthly annuity over a period of 10 years. Next calculation, let's see if you can do this one. The question is asking you to determine how much you would have to save today in order to provide for an annuity starting in 12 months' time, which pays you an amount of 500 Rand monthly at the start of each month for 4 years. You will use a savings account offering 6% compounded monthly. So if you have a question like this, you need to draw some sort of timeline. I would draw a timeline to show the one amount being invested and then the next amount being invested at a different rate. Okay, so determine how much you would have to save today, so T0, in order to provide for an annuity starting in 12 months' time, so in 12 months' time, which pays you an amount of 500 Rand monthly. PMT is 500 Rand for a period of 4 years. Okay, so that would be a period of 4 years using a rate of 6% compounded monthly. So I12 would be 6% divided by 12. Right, so you have one answer. You're going to be working out your future value here. This future value is going to be the present value here. Okay, and then we're going to be solving for that amount. Okay, so the question, what did the question ask for? Determine how much you would want to save today. Okay, it's today, so we need to work backwards. All right, so if we're working backwards, let me just get another color pen. Right, you have PMT here, you have N here, and you have I here. Okay, you've got 3 different variables. You can solve for your present value. Once you've got your present value, that'll be your future value, and then you would take that back to time 0. Right, so you're moving backwards rather than forwards here. And you just need to look at which diagram do I have more information. I have a lot more information in the second diagram. I have 3 knowns. I can solve the fourth unknown, which is the present value. Then I can solve for the present value here, which is what I would need to invest today in order to provide for this goal in the future. Right, so just to show the workings here, let me just delete all of this. Okay, the annuity part, we spoke about it, begin mode. Okay, the payment, obviously for those 4 years at a rate of 6% compounded monthly, then you compute your future value. That future value now becomes the present value. Sorry, I said future value. The present value now becomes the future value, which will then be used in the next calculation to work out how much you're going to be investing now. Right, so you're starting in the future, you're working your way back to T0, and you're trying to establish how much do you need today in order to provide for this goal in the future. Right, so again, please type in all those values in your calculator, get the one answer, then get the other answer, and then check your answer with the one that I have here for you on screen. Right, the answer you should be getting, present value of the annuity is 21,396.60969, and if you discount that back to times 0, you're going to get 20,153,58091. Okay, the next question is looking at determine how long it will take to pay off a loan of 200,000 which attracts interest at 15% compounded monthly, assuming that the monthly payments are going to be 3,200 and are going to be made at the end of each month. So once you've read that information, you need to pull out key words that link to the various variables that will be present in your time value of money calculation. So just to highlight the loan part of the question, you've obviously got a payment that's going to be made. Okay, the payment is, okay, I see there's a typo here. Okay, the payments are 3,200. Sorry, please change that. Okay, 3,200. Right, your present value is 200,000. Okay, and you're solving for the number of periods, taking the interest rate into consideration, which was compounded monthly. All right, so whatever we get for n is going to be a number of months. So the answer for this one is I see I haven't inserted the answer for this one. I'm going to be doing this calculation separately just so I can insert the answer for it for you. Okay, so on your financial calculator, make sure you clear the memory first. Let's insert the variables. I'm looking at I here. The I here was 15% compounded monthly. The present value here was the loan, which was 200,000, and that was going to be paid off with monthly payments of 3,200. And I'm solving for my I and my N. All right, I get 122 months. Let me just insert this here so you can see the answer. 122.3443998 months, because this was a monthly rate. And you can convert that to a number of years, perhaps, if you prefer. Right? If you divide that by 12, you're going to get just over 10 years, basically. Right? 10 years to pay off this loan, taking these numbers into consideration. All right, the next question. Here we're looking at time value of money again, except here we have a NPV and IRR calculation. Right, so this is something that you also need to be aware of, and you need to use your financial calculator to do this. You just have to insert all of these values into your cash flow function or your NPV function, and that NPV function is going to return the relevant values. Right, so IRR and the actual net present value. Right, so given the following cash flow schedule for the company X, that has a required return of 15%. The initial investment is 20,000 and will be needed to pay to secure the cash flow as per the schedule. Then they want you to calculate the NPV and the IRR of the investment and decide if the investment is a good decision. Right, so all we have to do is literally just insert these values into your calculator, into your cash flow function, in order to get the correct answer. Just remember that your initial times 0 amount is going to be the actual investment that you have outlaid. Okay, so Y0 is the initial investment, which is minus 200,000. Right, and then the rest would be plus in terms of cash flow. Let me just put up the answer again for you. All right, so if you do the working, you'll see net present value comes out to a negative 6856.598537, and your IRR is 1.4184%. Right, so you can see that based on this calculation, right, the required return was 15%. That's the required return. All right, here we only have an IRR of 1.41%, which is extremely low. So that's why your net present value is negative. Okay, no value is being created here. Value is actually being destroyed here, which is a problem. All right, you have one more to do. Very similar calculation here, except you're going to be calculating the NPV. All right, so here you have a following schedule of cash flows for company X, and the required rate of return is 15%. The investment of 20,000 will be needed today to secure the cash flow. Calculate the NPV. All right, so if you calculate your NPV, you're going to get the negative 6856.598537 with the internal rate of return. You can see that the internal rate of return is much lower than the required rate of return, and that can happen depending on the market and depending on what's happening for that particular company. Okay, just to summarize this last bit in terms of time value of money, please make sure that you do know what the differences are between a nominal rate and an effective rate. Also make sure that you are comfortable doing an equivalent rate conversion if you need to convert an interest rate into something that can be used in your calculations. And then make sure that all the variables relate. The number of periods need to relate to the interest rate, which relates to the number of payments that are being made. So when looking at time value of money calculations, I would definitely advise all of you to draw up little timelines just to make sure that you are on the right track, and you can see all those variables that you have that's on the diagram, and then you can just substitute what you know and solve for what you don't know, and that would probably be the best way of approaching these types of questions. All right, so please practice. You have lots of time value of money calculations to look at to get better at doing this particular calculation. All right, these calculations will be used at a later stage. We'll be covering a dividend discount model. In the dividend discount model, you're going to be using the cash flow function, and you're going to be moving amounts back in time. There's lots of different practical applications for time value of money. We'll be using it in share equity valuation, bonds or fixed interest securities, look at the valuation there. And then you've got quite a bit of statistics also, just to look at those basic measurements in statistics that you all need in order to do various calculations. Just remember that present value and discounting is taking amounts back in time, and we do that in order to generate a better indication of what's happening in the organization and where we should improve on. Right? It's always about making decisions based on information, and the more information we have, the better the decisions we can make. All right, just another additional note regarding practical applications. When I'm looking at fixed interest securities like bonds, I'm going to be using the same time value of money variables, except those variables are going to have very specific names. Right, so when I'm looking at any valuation, whether it's debt or equity, if I'm looking at stocks or shares and I'm evaluating the value of those shares, the same thing will apply. I need to identify the different variables in the time value of money calculation, substitute and solve, and get an answer that represents the actual value of those shares. Right, so just remember, fixed interest is bonds, and then fixed or ordinary share capital or ordinary shares or ordinary capital is just your owner's entitlement, your equity. So when we're looking at fixed interest securities, we're looking at debt, and then when we're looking at shares or stocks, we're looking at equity. Both follow the same evaluation principles when determining the amount, all right, that we're going to be using in various calculations and making decisions. All right, that takes us to the end of that particular study unit, which was quite long, but it requires practice to get better at doing those workings and calculations. Right, the last unit that we're going to be looking at here in week 2's set of notes is the valuation principles and practices. The first thing we need to debate is what exactly is a valuation? Take a minute or two just to think about that before you answer. Do we all have the same view on value? Do we all agree on what items are worth? That's the very, very big consideration when we're looking at any sort of retail space. We're trying to identify what is a fair valuation for a particular business, taking everything into consideration. Just remember, a valuation, this is also something will be covered in later in your textbook and your study guide, just to highlight the importance of being able to calculate all these different amounts. Right, so when we're looking at this valuation concept, just remember back to what we spoke about before. You get different markets. You get the primary market, the secondary market, and then obviously if we're looking at accounting and generating a system or set of financial statements, we then need to apply the same rules that we all understand. We've got assets, we've got liabilities, and then we've got owner's equity. Just remember that owner's equity comprises of those 4 other accounts. You've got capital, drawings, income, and expenses. All 4 of those accounts will affect owner's equity. So we need to be careful when we're doing those calculations. Right, just a bit more theory regarding how valuations are worked out in the real world. When you have any company, it doesn't matter which company, there's going to be some sort of investment committee or investment board that's going to make certain decisions. The most important decisions to make is if I'm picking stocks, if I'm choosing stocks, have I done so objectively? We're looking at valuations. We're looking at cash flows. Remember, businesses need to evaluate value. So in order to evaluate value, businesses need to make sure that they attend to all the calculations and they make sure that they discount or move future values back in time. Right? In other words, taking things back to T0 to work out the price. Right? So when we're looking at this whole concept of intrinsic value is what is the item actually worth? We've just discussed time value of money. If you take future amounts back in time, you're going to have an estimate of the time value of money for that particular scenario. So when looking at stock picking, you're going to compare intrinsic value to the market value. So if I'm trading at a premium, I'm going to have a market price that's greater than the intrinsic value or the net asset value. So just remember, when we're looking at over or undervalued, if this is trading at a premium, it's definitely considered overvalued. If it was trading at a discount, it would be considered undervalued. So when looking at this concept or idea of picking stocks or shares in terms of valuation, there are different measures that you can use to determine the share price for a particular asset. The most commonly used one is the dividend discounting module, or discounting future cash flows back in time. Dividends are cash flows, so that also needs to be considered. And then we also have an estimate of price based on the present value of those future cash flows. So we're just trying to establish a method that can be used to calculate the value of equity in this case, because we're looking at stock and shares. All right, then just something else to consider is the net asset value. This is an accounting formula where you're comparing your assets to liabilities and you're trying to determine net asset value. Just remember that the difference between your assets and your liabilities is going to give you the net asset value. You then need to take into consideration the denominator. So if I've got net asset value and I'm calculating net asset value and I'm determining what it is, I need to remember that the total assets less the total liabilities is going to give me an amount. And if I divide that by the number of issued shares, that's going to give me the net asset value per share. So if your shares are worth more than the net asset value, that would mean that those shares are trading at a premium. If it's less, then that would mean it is trading at a loss or a discount. Right, then just one other note regarding some fair value, intrinsic value discussion points from the textbook. When looking at bond valuation, everything stays exactly the same. When we get to that chapter on bonds, we will look at it in more detail, just so everyone's comfortable with the workings and calculations. Just remember, when looking specifically at intrinsic value, you're looking at how much is something actually worth, taking the current market situation into consideration. So when we're looking at equity valuation, there's a lot that we need to consider. We can use preference dividends, we can use constant growth model or constant dividends. We can use a 2-stage or a 3-stage or any stage really as a dividend model to discount future cash flows back in time to establish how much the equity is actually worth. So when we look at intrinsic value, just remember that we need to establish value or worth for a particular company. All right, and that concludes another set of study support notes. Please make sure that you are familiar with what time value of money is and how to apply that in different contexts. We will be looking at each of these contexts in more detail at a later stage. We will be focusing on the time value of money calculations, where you're trying to establish the cost price or the selling price depending on perspective. So just remember, there are many different example activities you can use to practice to make sure you're on the right track. All right, always practice to get better at doing practical subjects, and please email us if you have any problems.